Today in this video, we're going to talk about the 50-year mortgage and Fannie Mae dropping credit scores and whether that's going to make a difference in the housing market. Check it out. Hi, I'm Rhonda Burgess. I'm a real estate broker here in the Nashville, Tennessee area, and I'm also a mortgage underwriter, and my firm is Southern Living Realty Partners. Okay, we're going to get right to this. Let me just say this. Let me talk about the 50-year mortgage first. Let's do that. This is not new. Back before everything crashed in 08, 09, we had a couple of lenders, and I do mean it was no more than a handful, that introduced the 40-year. We could originate a 40-year mortgage. I mean, we could start you off on a 40-year. We used to do a lot of ARMs back then. We do a lot of 228s and 327s, meaning that's on the 30-year. So it would be, the rate would be fixed for 2 years and then it could adjust, or it'd be fixed for 3 years and then it could adjust. Same thing, we could do 40 years. I want to say, I remember maybe like one lender who would come out with a 50-year. Okay, so let me explain to you first the reason for the 40 years and the 50-year mortgages. We mainly pushed those or offered those to people who were doing a jumbo loan, like you were buying a really expensive piece of property. And you have to remember, back then, your definition of a jumbo loan was way lower. It was more like, 400,000 was, I think 450 was a jumbo. Above 450 or 500 was a jumbo. Now your jumbos are more like $1 million. So we had people who were wanting to buy these more expensive properties, but the 30-year, amortizing it over 30-year was not working. Okay, because number one, when you get into jumbo, that's got a bump on the price. Okay, so those loans automatically come with a higher interest rate. Okay, so that was the main reason why we came out with 40 and 50 years, because we were doing so many. This is when we were doing the NINAs, the no income, no asset, right? Anybody, if you could fog a mirror, if you were breathing, you know what, you could get a loan. I'm not saying it's right or wrong. I'm just telling you what it was. Okay. So when you have those NINAs and you had other programs where the income wasn't documented, let's just say you could do a stated income. We used to do a SISA too, stated income, stated asset, a no income, no asset. Okay. So when you're dealing with those type of programs, and you got people who want to buy need a larger loan amount. Okay, they buying 500, 600, 700,000, and the jumbo pricing is killing them. Then you would offer them a 40-year, so they could spread that out. It's a bigger loan amount. They could spread it out further, and you would have. I remember we had one lender that would actually do a 50. You could do a 40 all day long, but it was hard to find that 50-year loan. Okay, now let me tell you something else about that I see people online missing it. They're missing this part right here. Every video that I've seen is doing an example like this. So if you have a 30-year loan at 6%, or 6.25%, like whatever the rate is now, and then the payment would be $2,400, and then they show you that same 50-year at 6%, and they show it being like $300-400 cheaper. Okay, what you don't understand is that 50-year will never have the same rate as a 30. I'm gonna say it again for the people in the back. The 50-year does not have the same rate as a 30. It has a higher interest rate. So it's not, everybody's trying to make it seem like, oh, it would just be this simple. No, it's not, because I'm going to tell you why. Those 40s and those 50s always had a higher interest rate. You know why? Because people don't keep them. Listen, you got to, on this channel, I've always told y'all to follow the money. I try to explain stuff to y'all from the backside, from the side that don't nobody else tell you about, because then you'll understand the pricing and the underwriting and everything. Okay, it's all about the money. Listen, if somebody's going to take a 40-year, let's say we were even doing an ARM or a 40-year fixed rate, it doesn't matter, 40 or 50. On average, the customers who take that type of loan, who do a 40 or 50, they don't keep them nearly as long as the 30-year, okay? Because the 40-year back in the day and the 50 were meant to be just to get you into that property, right? It just needed to make your DTI work to get you in, for you to be able to close, for you to be able to purchase. Then it was always intended, because again, it was an ARM, okay? It's an adjustable rate mortgage, and it was only fixed for 2 or 3 years. So it was always intended for you to refinance and come out of that loan, okay? So if I'm the lender, if I'm the actual entity who's going to lend you this money, right? And let's say I do 30s, 40s, and 50s, okay? My 30-year, I can look historically and tell how long people keep that loan before they refinance out of it, okay? It may be 5 years, it may be 7 years, it may be whatever. Or it may be that they stay in it 5, 7, 10 years if the interest rate is 6.5 or below. But if the interest rate is above 6 or whatever number, you know what I'm saying? Believe me, these mortgage companies do their research. They do their research. So they know that if the present interest rate that they close at is at 6 or below, they'll keep that loan for 10 years. Cool. But if their research also shows that when it's a 6.5 or above, let's say, people only keep those loans an average of 3 years before they refinance. So that means I'm only going to make money off of servicing that loan for 3 years. Okay, if I'm servicing my own loans, if I'm servicing that loan, or even if I'm selling that servicing, we're only looking at an average of 3 years. Y'all, there's so much money in the servicing of mortgages, in the servicing of the loan. That means this is why you see your loans get sold. You know, you'll be paying Wells Fargo, and then you get a notice in the mail that starting, next month, it's going to be Bank of America, or it's going to be, the Money Store. It's going to be Freedom Mortgage. It's going to be whoever, right? Because there's big money in servicing those loans. So again, if I am a servicer, right? And so I want to get all this money in every month for servicing that loan. So let me explain that to you. Let's say your monthly payment is $1,500, okay? And you got it at your local credit union. Your local credit union does not service loans. So then they're going to take that loan and they're going to sell the servicing, okay? So let's say they sell it to a Bank of America, okay? So out of that $1,500, they may be paying Bank of America $200 or $250 or whatever number, okay? I want y'all to understand that whole amount, the servicing mortgage company, the servicer has got to be paid for collecting those payments, sending out the statement, following up with you, running you down, calling you when you go late or you're behind. That servicer is also the one in charge of, especially if you've got an escrow account attached to that mortgage, which the majority do. They're responsible for paying the taxes and the insurance and monitoring the escrow account and everything. There's a lot that goes into servicing the loan. Okay, so those servicers get paid to do that. Okay, all right. So if and everybody has done their numbers. These when you're following the money, they've done their research. So if they know that on the average on a 30-year, they may get five years of servicing. Okay, so then they can project how much revenue they're going to generate off of each 30-year loan. But if the 40s and the 50s, on average, people only keep them 12 to 18 months. because it's just a temporary. Those are a patch loan. I call them a patch loan because you will never keep a 40-year loan. You would never keep a 50-year loan. Okay. It's just the stigma to it. Just listen to it. 40 or 50-year loan. No, nobody want to do that. Okay. And people, you're not finna tell nobody. You're not finna tell your girlfriend. You're not finna tell your cousin them and mom and them and all of that you got a 40-year loan or you got a 50-year loan. Because then they gonna look at you like you crazy. Because that's not the norm. Okay. So again, people are only keeping, if they're only keeping that loan, let's say 18 months before it is refinanced back into a 30-year or into some other type of loan, then I'm going to charge, if I'm the servicer, I'm going to charge you even more money per month. I'm going to charge your originating mortgage company, the one that wants to sell it, the ones that wants me to service it. I'm going to charge them even more because you know what? I'm not going to make that much money on this loan because they're not going to keep those loans. They're not going to keep those loans. Historically, they do not. This is why, to me, this whole 50-year talk, irrelevant. We've tried this before. Those of us who've been in the game for a while, we remember these loans. We remember these. I think I've done, in all them years I was originating, I think I did 140 a year. And it was on a true like jumbo. These people trying to buy like 1.2 million. And so we had to stretch it out to make the numbers work. But after that, nobody keeps that loan. This is why that 50-year. So when y'all hear them talking about these 50-year, two things you need to remember. That interest rate is not going to be the same as a 30-year interest rate. It's going to be higher because you've got to incentivize the mortgage company, the lender. You've got to incentivize them. Because why would I give you a 50-year loan at the same price as a 30-year loan at the same interest rate? And I know this 50-year loan is going to be harder for me to sell the servicing. That's not a Fannie Mae or Freddie Mac product. So I'm going to end up, where am I going to be able to sell this bad boy on the market? I can't put, if you look at Fannie Mae's guidelines and Freddie Mac, FHA, USDA, everybody, there's nothing in those guidelines about a 50-year mortgage. So who are you going to sell it to? You not. If I'm doing a 50-year mortgage, I'm lending you money over 50 years. I'm not, first of all, I got to raise that interest rate. So if the going rate is 6.5, I'm going to need to charge at least 8.5 to make any money, to make it worth my while. And so then, and then I got a short window when I go to servicing it, to sell the servicing it doesn't make sense. So don't get caught up in the hype of these 50-year mortgages. I don't see it working. It didn't work before. It did not work before. And now we have a much higher limit for jumbos. You can buy almost $1 million on an FHA loan and still not get hit with jumbo pricing. Meaning jumbo, when you get to a certain loan amount, there's a bump on the rate because it's a jumbo. Okay, because it's a big loan. So don't get caught up in the hype of this 50-year mortgage. I don't see it where it didn't work before. And it's just not going to be popular enough for enough lenders to get behind it. Remember what I've always told y'all about a lot of people who work in policy, meaning they come out with these loan programs or these thoughts of different loans. Like I've went over the USDA construction loan that we're not even going to get into that. I'll link that video for you, but we're not going to get into that. But anyway, a lot of people who write or suggest policy do not operate in the real world when it comes to mortgage lending. Okay. Okay. And the second thing I want to go over is Fannie Mae saying they're not going to require a credit score anymore. It's irrelevant. I'm sorry, it is irrelevant. Fannie Mae does not lend money. I'm going to say it again for the people in the back. Fannie Mae does not lend money. Okay? Y'all need to know what Fannie Mae does. Federal National Mortgage Association. When your bank, you go to your bank, whoever your bank is, whoever your mortgage broker is, you go wherever, okay? You getting a loan from them. You're going to get a statement, just like I just talked about servicing. But initially, when you're going through the origination process and you're trying to get your mortgage to get into your property, okay, you're dealing with Bank of America, a Regions Bank, whoever you're dealing with on the bank level, your credit union. You may go through a mortgage broker, and they're brokering through United Wholesale, Freedom, different companies like this, okay? So those are the companies that lend you the money. Fannie Mae does not, okay? Fannie Mae is a quasi-government entity, okay? And what they'll do is they will purchase your mortgage from Bank of America. They just originated it. You close, you're going to get a statement probably that Bank of America may service that loan for the first 2-3 months. Then they may sell it themselves. But you owe your money to Bank of America. You don't see Fannie Mae in here nowhere. You can go through every document, every disclosure. You will never see Fannie Mae. But what you will see, they will say that your loan may be assigned a MERS number, MERS. Okay? That means that they're going to take that loan, your loan, and they're going to put it with a whole bunch of other loans, right? And Fannie Mae then is going to come buy those loans from all these different lenders, from all these different mortgage companies and banks. And they're going to package them together. And they're going to assign it a MERS number. That's the Mortgage Electronic Registration Service. I do believe that's the exact. But they're going to assign it a MERS number because they're going to put them all together. They're going to get a whole bunch of them, different ones, right? And they're going to put them together, and then they're going to sell them to investors. This is how the banks get the money to do the next loan. Because there are companies that just invest in mortgage-backed securities. You'll see a lot of those are going to be your pension funds, your retirement funds, different things like that. They buy a lot of mortgage-backed securities. So the fact that Fannie Mae says we're not going to require credit scores anymore, to me, is totally irrelevant. It does not matter one iota, because every single bank, every single lender has an overlay, and that's what we call it. That's what we call it in the business, an overlay. That means, and I've gone over this with y'all before. Remember, look at some of the previous videos. If Fannie Mae is not requiring a credit score, that's cool. But Bank of America may require a 640. Do you see how it's irrelevant? Because the people who are actually lending you the money, they have their own criteria. Again, Fannie Mae, you will never get a mortgage statement that says Fannie Mae is your bank. Because Fannie Mae doesn't do that. They buy the loans, package them together, and sell them off as a mortgage-backed security. Okay? So the fact that Fannie Mae is saying, oh, okay, yeah, we're not going to require a credit score. Okay, that's irrelevant. Because every single solitary lender, I have never seen a lender who does not have their own overlay. Meaning they all have some type of criteria. Because they've done their research too. It's all about doing your homework, do your homework, do your homework. When I tell y'all do your homework, it's because these mortgage companies have done their homework, okay? So they know, they will look historically and say, okay, when we did loans that when we didn't require a credit score, or these people had a lower than average credit score, what was the result? I bet you money, their research will say that they had a higher default rate. They went into foreclosure, they fell behind. And so that means servicing had to spend more time and money servicing that loan. Listen to what I'm saying to you. If the research said that the low credit scores, those loans did not perform as well, meaning they were running, but they fell behind. They were foreclosed on. They let their insurance lapse, and then we had to put that high cost insurance on them. Whatever. If historically it says those loans did not perform as well, okay, they stopped doing them. They would raise the credit score and raise the credit requirements. I did a video, I think it was in October, or I don't know when, where I said about how as an underwriter I have to validate your score. And it depends on the lender. So some lenders may require, and I went over this, I'll link it to, like it may require you have at least one trade line with a $5,000 high credit that's been open for 12 months or whatever. And then you got to have a total of 3 trade lines that have reported for so many months, and how many can be closed and how many have to be open and everything. Do you see what I'm saying? So the fact that Fannie Mae saying, oh, we're going to drop our credit requirement, that don't mean nothing. Because every single lender, I've never seen one that doesn't have this. Okay? Every single lender will have their own overlay where they have a minimum credit score or a minimum trade line or a minimum something, because they're looking at the end. They're looking at, okay, if it's going to cost me more to get this loan serviced, and believe me, your servicing mortgage companies, they know this too. So what I'm saying to you is, let's say your mortgage company is ABC Mortgage Company, right? And they drop the minimum credit score because Fannie Mae dropped the minimum credit score. Okay? I'm going to tell you for a fact, when ABC Mortgage goes to try to sell that servicing, they're going to have a problem. Because whoever that servicing bank is, Bank of America, Wells, Freedom, whoever, they're going to be like, ooh. They're going to be like, what? They didn't have no credit score, or they had a lower than average credit score. So then that means that's telling me, I'm going to have to, that's more man hours for my employees who are going to service these loans, because they liable to fall behind or whatever. And we got to have to run them down, and we liable to have more foreclosures or whatever. That's irrelevant. So don't y'all get all excited. Oh, Fannie Mae dropped their credit score. The only people that's going to help are the people who have truly no freaking credit score. None whatsoever. Those are the only people it's going to help. And let's just look at it. Right now, the average age of your first time buyer is 38 years old. So you mean to tell me you gonna have a whole bunch of 38, 40-year-old, 35-year-old people with no credit? No, man, you see that in your 20-year-olds. You do not see that in your 30-something-year-old people pushing 40. Yes, the age of the average first-time buyer has gotten up to 38. The homeowner, I know the 20s, my people in your 20s, y'all getting shut out. I'd already bought 3 houses before I turned 30. Y'all will not have this opportunity. I am sorry, baby. I am really sorry. But just so you know, that this is going to affect a minuscule number of people. Because I never hardly run into 30-something, 40-year-old people with no credit score and no credit history to speak of. Again, my name is Rhonda Burgess, and I'm going to put the link up on the screen. I got some freebies for y'all to help you with your debt calculation, and I got some worksheets and some planners, and you'll see in the link, rhondaburgess.com/freebies. Check it out. Get whatever you need. It's no charge to you. I'm not going to be bothering you. I ain't wanting people to keep on emailing and all the time, every day, 8 times a day. I don't do that. I'm just trying to help y'all. And also remember, pick up your credit worthy period shirt. The link is below. Thank you. And as always, have a blessed day.